Welcome to Decode Station. I'm Sarah. Tonight, we deconstruct one of Silicon Valley's most expensive illusions. A $47 billion company built on hype, charisma, and a business model that was never designed to survive.
Thanks, Sarah. WeWork wasn't just a failed startup. It was a case study in how narrative can override financial fundamentals.
It really is the ultimate cautionary tale of the last decade, isn't it? We're looking at a company that, at its absolute peak in 2018, was valued at $47 billion.
Yeah, a massive number.
It had a presence in over 100 cities. For you listening, it probably felt inevitable, right? Like Starbucks or Google.
It was everywhere.
Exactly. And yet, beneath that glossy surface of, fruit water, craft beer, and neon signs saying, do what you love, the foundation wasn't just cracking, it was completely non-existent.
Which is why we're here.
Right. So tonight, we are doing a deep dive into the rise and fall of WeWork. We have the forensic accounting, the timeline of that explosion in value, and the psychological profile of a market that just really wanted to believe.
It's a fascinating story because it sits right at the intersection of hard finance and human psychology.
Definitely.
We have a mountain of data for this, deep dive financial reports, the infamous S1 filing, analyst retrospectives. But to understand this, you really have to understand the environment it was born into.
We're basically performing an autopsy on a delusion.
That's a great way to put it. We need to figure out how smart people with billions of dollars were convinced that a landlord was actually a tech company.
That is the core mystery for us today. So let's rewind a bit. Picture New York City, 2010. The financial crisis is still very visible in the rearview mirror. Office space is cheap because, well, nobody is hiring.
Right.
Enter the founders. Now, stripping away the mythology they built up later, what was the actual mechanism of the business they started?
If you look at the bare metal of the business, it was incredibly old school. It was commercial real estate arbitrage.
Arbitrage.
Yeah, the model is simple. You lease a whole floor or an entire building from a property owner for a long time, say 15 years.
Because you get a wholesale price for taking that much space.
Exactly. Then you renovate it, slice that floor up into tiny glass boxes, put in some mid-century modern furniture, and rent those boxes out month to month at a retail markup.
Right, which is not a new invention. That's what other companies have been doing since the 1980s. It's essentially what boarding houses did in the 1800s. You buy in bulk, you sell in pieces.
Precisely. There is zero technology involved in the basic transaction of renting a desk. But here is the genius, or the grift, depending on how you look at it.
Okay.
The leadership understood that if you walk into a venture capital firm and say, I'm starting a real estate subletting business, you get a polite nod and maybe a bank loan at 5% interest.
Because real estate companies are valued at low multiples, right?
Yeah. They are capital intensive, they carry a lot of debt, and they are notoriously hard to scale.
But tech companies, that's a different story.
Completely different. Tech companies are valued at 10 times, 20 times, sometimes 50 times their revenue.
Because software scales infinitely.
Exactly. Once you write the code for an app, it costs you almost nothing to sell it to the millionth customer. So they didn't sell desks. They sold a physical social network.
They marketed it as a platform.
Yes. They used the language of Silicon Valley to describe a brick-and-mortar operation.
It's fascinating how language totally shaped the valuation here. They claimed they were elevating the world's consciousness. They weren't just giving you a place to plug in your laptop. They were giving you a community.
And that word community was the magic key. It unlocked access to venture capital that is usually heavily guarded and reserved for software startups.
They managed to convince the world's most sophisticated investors that physical space could be treated like software code. Like they were creators of a physical operating system.
Marcus, how did investors pour billions into WeWork without realizing the company was losing money on every desk it rented? Was this innovation or was it financial theater? That is the $47 billion question. I think we have to look at what behavioral economists call visionary bias.
Visionary bias.
Yeah. The leadership wasn't just pitching a P&L statement. They pitched a revolution. The main founder was this charismatic force of nature. He spoke with this intense, almost spiritual conviction.
He made skepticism feel uncool. Like if you were asking about profit margins or occupancy rates, you just didn't get it. You lacked imagination.
Precisely. He weaponized the fear of missing out. He created a narrative that this company was going to change how humanity lived, worked, and interacted.
And When you, as an investor, are sold a vision of the future that big, you tend to stop looking at the unit economics of the present.
You do. He distracted them with the global community narrative so they wouldn't look at the plumbing.
So the investors were buying the storyteller, not just the story, and that story drove one of the most aggressive expansion phases we have ever seen.
Without a doubt.
Let's look at the numbers here, because the jump in valuation is honestly staggering.
It is exponential, let's trace it. In 2014, the company was valued at $5 billion.
Which is impressive, but not world-changing.
Right. But 2 years later, in 2016, that number more than triples to $16 billion.
Oh, okay.
And then, just 2 years after that, in 2018, they hit that peak valuation of $47 billion.
To put that in perspective for you listening, at that moment, this workspace company was worth more than Ford Motors or FedEx.
It's wild.
And this was for a company that didn't even own its buildings.
Correct. They were just leasing the space. But the physical footprint was exploding alongside that valuation. They scaled to over 100 cities, 500 locations.
500,000 members. It felt like they were conquering the world because you saw their logos on every corner in London, New York, Tokyo.
But we can't talk about this explosion without talking about the accelerant.
Right, the venture capital side of things. We have to talk about SoftBank.
Yes, the SoftBank Vision Fund. This is a critical piece of the puzzle. They are famous for making massive bets on the future.
The story goes that the head of SoftBank took a 28-minute tour of an office and then famously told the founder that he wasn't being crazy enough.
Imagine telling a guy with that much ambition, he isn't crazy enough.
That's like handing a pyromaniac a flamethrower.
It effectively was.
Yeah.
SoftBank pumped over $10 billion into the company. And that kind of money distorts reality.
How so?
It triggers herd behavior. When the biggest, deepest-pocketed player in the room says, "This is the winner," other investors just assume SoftBank knows something they don't.
So they stop doing their own due diligence. They just want on the train.
Exactly. It becomes a self-fulfilling prophecy. The money allows them to grow at all costs. The growth justifies the valuation, and the valuation attracts more money.
But as they say in finance, revenue is vanity, profit is sanity. And this is where we need to start peeling back the layers of this deep dive.
Because while the valuation was skyrocketing, the actual business mechanics were deeply troubled.
Troubled is a polite way to put it. This brings us to the cracks beneath the surface. When you strip away the community rhetoric and the tech label, there was a fundamental structural flaw here.
Yes. We call this an asset-liability mismatch.
Break that down for us. It sounds technical, but it's actually pretty intuitive, right?
It is. Think about it like this. For you listening, imagine you sign a lease for an apartment for 10 years. You are legally obligated to pay that rent every month for a decade.
Okay, that makes sense.
That is a long-term liability. It is fixed. It doesn't go away. Now, imagine you try to pay that rent by subletting the bedrooms to people who can move out with just 1 month's notice.
That is short-term revenue.
Exactly.
I see the problem. If the economy takes a dip and your subletters move out,
You are still on the hook for the 10-year lease. Your costs are fixed and long-term, but your revenue is variable and short-term.
wow. And they had signed billions of dollars in these lease obligations.
Commitments stretching out 15 years in some cases, but their customers could cancel instantly. It made the business incredibly fragile.
And we can see that fragility in the cash burn rate. I'm looking at the loss figures here from our sources, and they are eye-watering.
Let's hear them.
In 2016, they lost $430 million. Not great, but maybe understandable for a high-growth startup.
Right.
But in 2017, the loss more than doubled to $933 million. And in 2018, the year they hit that peak valuation, they lost $1.9 billion.
That is the key metric right there. Revenue was increasing, yes, but losses were increasing faster.
Which indicates the model doesn't work.
It means it does not scale profitably. Usually in a tech company, which they claim to be, your margins get better as you get bigger.
Because it costs a software company almost nothing to sell one more license.
Exactly. But for this company, every new location meant more rent, more renovation, more staff.
Yeah.
The bigger they got, the more money they lost. The growth was actually toxic.
But to hide this, they used some pretty creative accounting.
Creative is an understatement. They invented a metric called community-adjusted EBITDA.
What does that even mean?
Essentially, they said, if we ignore the cost of marketing and administration and the cost of building the actual offices we're profitable.
That's absurd.
It was pure financial theater designed to trick casual observers.
But it wasn't just the math that was problematic, it was the governance. The internal behavior described in the reports is shocking.
The red flags were everywhere.
We have instances of the CEO purchasing buildings personally and then leasing them back to his own company.
Which is a classic conflict of interest. As the CEO, he should be negotiating the best deal for the company. As the landlord, he wants the highest rent for himself. He was essentially sitting on both sides of the negotiating table.
And then there's the trademark issue. This one always blows my mind.
The We trademark.
Yes, the company decided to rebrand from WeWork to the We Company. And it turns out the founder personally owned the trademark for the word we.
Right.
So the company paid him its own CEO $5.9 million to buy the rights to the word we.
It's startling. It signaled a complete lack of accountability. It showed that the founder had excessive control over decisions and that the board was either unable or unwilling to rein him in.
A huge red flag for corporate governance. It showed he viewed the company as his personal ATM.
And yet the valuation kept holding. The music kept playing.
Until 2019. That's when they decided to try and go public.
The IPO attempt. This was the ultimate catalyst for the collapse. To go public, a company has to file an S-1 document with the SEC. It's a disclosure form.
And for private companies, you can control the narrative, right? You can pick and choose what numbers you share in a press release.
Exactly. But the S-1 is a legal document. It requires full transparency.
It's like turning on the fluorescent lights in a nightclub at 3 a.m. Suddenly things don't look so glamorous.
That is a perfect analogy. The S-1 filing in 2019 exposed everything we just discussed. It laid bare the massive losses, that $1.9 billion figure.
It was all out in the open.
It detailed the governance risks and the bizarre related party transactions like that trademark sale.
Yeah.
It showed an overdependence on leadership and, crucially, a really weak path to profitability.
The reaction from the market was immediate.
It was brutal. Institutional investors, the people who manage pension funds and mutual funds, they looked at the data and said, this isn't a tech company. This is a real estate company bleeding cash with a governance nightmare at the helm.
The valuation plummeted. It went from that lofty $47 billion down to less than $10 billion in a matter of weeks.
Which is a staggering destruction of perceived value.
It shows how quickly a narrative evaporates when faced with hard data. The tech company illusion just shattered completely.
The IPO had to be canceled because there was simply no demand for the shares at a price that made sense. And the consequences for leadership were swift.
The founder was forced to resign as CEO.
Yes. Transparency killed the narrative. Once the data was public, the game was over.
That's a powerful takeaway. But the story didn't just end there. The company didn't immediately disappear.
No, it went into survival mode. SoftBank, having already invested so much, had to intervene. They essentially bailed out the company to prevent immediate bankruptcy.
Throwing good money after bad.
They put in billions more just to stabilize the ship.
And that led to massive layoffs and restructuring across the board. They did eventually go public, didn't they?
They did in 2021, but via a SPAC and at a much, much lower valuation. It was a shadow of the 2018 peak.
But even going public wasn't enough to solve the fundamental issues.
No, because the structural flaws we talked about were still there. The long-term lease obligations were still choking them. Add in a post-pandemic office market that was incredibly weak.
Right, nobody was going into the office anyway.
Exactly. And so in 2023, the inevitable finally happened. They filed for bankruptcy protection.
It really is the end of an era for that kind of unchecked Silicon Valley hubris. So, as we wrap up this deep dive, when we conduct the final autopsy on this $47 billion collapse, what are the core causes, if you had to boil it down for the listener?
I'd categorize it into four main buckets. First, the structural flaw. That mismatch between long-term costs and short-term revenue. It is a deadly mix, especially in a downturn.
Makes sense. Second
is overvaluation. The price tag was based entirely on a story, a narrative, rather than financial fundamentals.
Third,
leadership risk. You had excessive founder control and incredibly poor governance that allowed for reckless spending without any adult supervision.
and the final one.
An unsustainable growth strategy. They prioritized getting big over making money, assuming they could just figure out the profit part later.
It seems so obvious in hindsight. Why didn't people see it? Or rather, why did everyone want to believe it so badly?
That brings us back to the psychological component.
Correct.
We mentioned visionary bias and herd behavior. There is a powerful desire in the market to find the next big thing, the next Amazon.
Investors were so afraid of missing out that they suspended their own skepticism.
The story was simply more influential than the spreadsheet.
It's a stark reminder for anyone investing that valuation does not equal value. Just because someone says a company is worth 47 billion doesn't mean the business fundamentals actually support that.
Exactly. Narrative can temporarily override financial reality. You can keep the balloon inflated with hot air for a long time. But eventually, gravity kicks in. Eventually, the cash flow, or the lack thereof, determines the outcome.
Looking at the landscape today, do you think we've learned this lesson? Or are startup valuations today still vulnerable to this exact kind of hype-driven inflation?
It's a cyclical phenomenon. While this specific company is a massive cautionary tale that everyone points to now, the psychological drivers haven't changed one bit.
You think it's still happening?
We still see sectors, look at AI right now, for example, where valuations are running far ahead of actual revenue. The fear of missing out, the allure of the charismatic visionary, the belief that this time is different, those are constant human traits in the market.
The market has a short memory.
Very short. We might not see another real estate company masquerading as software anytime soon, but we will certainly see other companies where the narrative outpaces the reality. We always do.
Stay curious, stay skeptical. Goodbye.